we go with cost leadership or differentiation? Shall we go with the long-term planning or short-term planning? But we are not thinking from risk perspective. But what ERM is saying in chapter 2 risk management, what we have discussed, they are saying risk should be integrated. Previously, what used to happen in organization, they'll make a strategy, everything will be finalized, then they'll talk about risk management. But here, the point is when you're selecting strategy, you should think of risk. Risk management should be more of proactive approach than reactive. It should be integrated in every step the organization is taking. So what will happen? The decisions we are making can be different. That's what they are trying to say. So they have not given directly about managing, they are just explaining it. Okay. And little bit risk they have involved. For example, if we talk about traditional market and resource base, same thing is there. We don't need to go through that again. But risk, if you see, market led, what is the risk? Predicting the future. We don't know. And sometimes the disadvantage mentioned there are being looked from here as a risk also. For example, if you are saying resource based approach, what can be the risk? Company become obsessed by the things that they can do and lose sight of what is happening in the market and what the customer wants. If we are looking only at our core competency, maybe that competency doesn't have enough weightage in the market, then we can get obsessed by this and lose the market potential or lose the market way out what they are looking for. Then with the traditional approach, what is traditional approach? It's about prioritizing the shareholders and the profit. So objectives are set in isolation from market considerations and are thus unrealistic. They're just looking at their own profit. So ultimately, even we have discussed there, it should be mix of all three. We cannot just focus on market and ignore the resource and traditional approach. We have to find a mix and balance of all three. Then we can manage the risk also and we can get the upside also. Okay. Where to compete, how to compete, which investment vehicle to choose. Again, everything we have to look from risk perspective. There is something return, investment and return. That is different thing. ROI, what you are looking at. But risk is totally different. Sometimes what happened, we might lose just a small part of finance of that. Maybe ROI is not get affected. But reputation risk coming from that will be so big, it will affect entire organization at a global level. So what we have to do is we have to see what risk it's involved. For example, if there is, like in today's days, there is some viral video of our employees on the ground misbehaving with, let's say, the clients or anybody. So what will happen? Because of social media, it won't affect the reputation only for that particular office, but are all clients globally. They'll say, oh, Saefwell employees are very rude. Something like this can come up. And our competitors can also use for their benefit. And if you see financially, it might have not cost us anything that time. Maybe no fines also. But on the risk part, reputational risk part, it is costing us very high. And as we know, one risk can lead to another risk. Reputational risk can lead to litigation risk. There might be litigation. Litigation risk can lead to financial risk. Financial risk can lead to business risk. All risks are interconnected. Okay. Sometime in exams also they'll ask you a direct question saying that we are trying to choose this strategy and what do you think are risk involved in that? So when they ask you risk involved, they are not actually asking you how much return we can get, what is the competitive advantage. No, that is solely based on the risk. So your answer should also be from the risk perspective. Or sometimes they'll ask you what is the advantages of this. So advantage means you don't need to talk about risk. You just need to talk about what financial returns and other benefit will get, like market share, brand value, all of those. You're getting the point? So every strategy we use, cost leader, differentiation, focus, it will involve certain risk. For example, if there is a company who's using cost leader, who is famous in the market for giving products for cheap, do you think if tomorrow they start to sell a luxury product at a very expensive price, people will buy? Can we imagine a very luxury brand coming out of China? and let's say if made in China is written, so what will happen? What our subconscious mind will say? Will doubt it, right? But if the same thing, maybe a lesser quality coming, let's say from Italy or France, let's say even US, so what will happen? There will be higher perceived value. Or even the company name. If some companies are famous to sell products for cheap and suddenly they started selling a very higher version, very difficult for them to sell. That's what they are saying. There is no fallback if the leadership position is lost. So what companies do to manage this risk? They will make a new brand, a brand which is luxury, a brand which is not so luxury. For example, there is a mobile company which sells Oppo. I don't know if they're in Africa, but in India they sell Oppo, Vivo. Both are like a cost leader product. But there is a luxury product of same company called OnePlus. Very few people know that all three brands is owned by the same company. You can even see they both are competing each other in marketing billboards just next to each other. But ultimately they are same. So what they have done in cost leader itself, they have made their two brand, and in differentiation they have made a luxury brand. But ultimately it's owned by the same. But imagine that Oppo or Vivo selling luxury brand, people won't pay 3, 4 or even 5 times the price. You're getting the point? Hello?
Yes, Misbah.
So same thing, Saefwell. If Saefwell want to start some niche product or focused product, and let's say it's very luxury, maybe we are providing security for HNI, high net worth individuals, 1% population, very rich. So you have to create something like a luxury for that, because if we just uh, brand it like a normal one, then they will say any small office is also having Saefwell security, and these people are also having Saefwell security. Maybe the company is same, but a new branding should be done. And branding is more about creating a perceived value, higher perceived value. Value can be higher in most of the cases, but the higher perceived value should be there. They should perceive it, at least it is so much high. Otherwise, why people are paying extra money for the logo? It doesn't enhance the quality of the product, right? So the organization must continually adapt to ensure unit prices are kept low and consumer needs are met. So every strategy will have some risk. If you're being a differentiator, so you have to continuously justify your higher price. So what is the risk here? There is need to continually innovate and defend the position. Continue innovate and show that why they deserve extra price. And obviously, majority of the market globally will go for cost leader. So here the selling points will be less, smaller volumes, but you have to have higher margin. Higher margin, but out of that, most of the money can go for marketing also. Smaller volumes, associated costs such as marketing are higher. Performance in recession may be poor. Yesterday we are discussing about economic situation. If economic situation goes down, if there is a recession, so people will obviously go for considered product. Even if it is basic need, they won't go for a differentiator product. If you think as a opposite, performance in economic boom may be better or may be higher because people have more money to spend. They'll go for a differentiator brand. And third one about focus or niche can be done via specialization by location, type of end user, product or product line. So niche can be of anything, location, product, individual, all of this. But again, we have to keep on defending that. What is the risk here? Low volumes may be sold because it's very bespoke, very tailored for them. If successful, it may attract other cost leaders differentiated to potentially low barriers to it. If it is successful, other competitors might also copy this. But in the starting, there is no much competition here, very few. Why? Because the market itself is very small. So what we have to understand here is whatever we are doing, risk is involved, risk management is important. Same thing with the market development. This, I think we have already discussed that. And I've been, I think I told you before, but again, I'll revise. when you are doing the pre-scene analysis, no, we need to have a list of what market development we can do, what product development we can do, and if you can add market penetration and diversification option also is good. Yesterday also I was mentioning it. So when you are doing a pre-scene summary, you can just add about it. Okay. I think yesterday Shiv was saying some points on market development, right, Shiv? So you can put this into this diagram also. You can do it separately, but have some points ready. For example, if you want to do product development, we can do this, this, and this.
Okay.
Related unrelated diversification can be there. Acquisition and merger questions are also very common. What is acquisition? Refers to corporate action which one company buys most, if not all, of the target's company's ownership stake. Merger is when two companies, let's say A and B, come together and form company AB. Organic growth is doing on our own, which is very rare for a company like Saefwell because it will take a lot of time. And we have finance, so we can go with merger or acquisition. Why to take a very slower route? Again, it will have its benefits and risk involved. Okay, let's go through this quickly. Then you guys can think of what will be the benefit for Saefwell. Okay, what is the benefit if you go with acquisition or merger? Obviously, high speed access to resources, barriers to entry. So what happens is in certain place you need license. You need to go through a lot of scrutiny to get into that. But if you acquire an existing competitor, easily you can jump in. Less reaction from competitors. So what happened? The same company is there, but the ownership has changed. Even sometime we will not change the brand name also, but just the ownership has changed. For example, airline in India, Indian Airlines, it was owned by government, but now it owned by Tata Group. So they have not changed the name. Nothing has changed. So less reaction for the competitor. Just the ownership has changed. It can even block the competitor, help restructuring the operating environment, P ratio, asset valuations, all this can be used in favor. Risk, more costly comparison to organic growth. We are saving time, high speed, so we have to pay cost of it. We won't come free. Cultural mismatch, yesterday also we discussed, especially if it is having international merger or acquisition. Culturally, it will be very difficult. In fact, if you just go by the data, most of the acquisition or merger will not achieve their desired target. You know why? Because of cultural mismatch. I'm not saying they'll fail completely, but they will not attain their desired target. Disposal of asset. They want to sell some part of asset, even if companies want or not target company. Lack of knowledge, due diligence, reduction on return on capital employed. So this might be the risk. Can we say all risk is involved in all acquisition mergers? No. But some might involve more risk also, some might involve less risk also.
So please read this relative P ratio in the end of the benefits.
We'll basically P ratio, they are talking about price earning ratio. We'll see this in F3 Puja. So what happens is in one of the valuation, in business valuation, what we do, we just take a net profit and multiply it by P ratio. That is one of the way of valuing the business. So what companies do in artificially to increase the market value of the company, market valuation of the company, they'll acquire some company just to improve the P. That can
This
be that.
P is very common actually. This P is very common in company valuation and the stock market also. Very, very important.
Because every
People
company.
buy based on P ratio.
Sorry, continue, sir.
People buy shares based on this P ratio mostly.
Yes, we'll see this in detail when we are studying business valuation. Okay. So what we are trying to do, artificially increase the price.
And so what is this asset stripping operation? Last point, asset valuation.
If they feel like the assets are not worth it, they'll just sell it off. If they are getting undervalued, or if they think like, usually what happened if you do an acquisition in the same industry. Let's say Saefwell acquire another security company. So let's say we have a fleet of vehicles and we don't need so much vehicle in the same location. What we'll do is sell it off. Why? Because it's not giving us good return. That is again common. Sometimes it will work in benefit also, sometimes it can be a problem also. What do you think is a better option for Saefwell? Shall we go with the organic, or shall we go with merger or acquisition? And why?
Obviously, merger and acquisition, because in this industry, a lot of means investment is there. Apart from that, means technology, experienced people are required. So that's why we should go for merger and acquisition. We can't go organic.
One point is that like this, you have to give 4 to 5 legitimate points if this question comes up.
Yes, a competitor, barrier to competitors. And when same thing, we should high speed. We would get the high speed if we go for merger acquisition.
So basically, we need to describe benefits actually.
I mean, it's not necessarily benefit. Firstly, it depends on what you're talking about. If you are against mergers acquisition, in real world, everything will have its upside and downside. Because here we can see so much benefit, but there is a fact we should understand. More than 50% in mergers and acquisition fail to achieve desired synergy, fail to achieve desired target. So that is also a very strong point if you are against this, if you want your company to go organic. So technically both are correct. How you justify it, what you're talking is important. Okay.
Okay.
Then due diligence. What is due diligence? Due diligence is just basically the investigation in detail. It can be of any type: financial, strategy, employee management issues, property, depending on the business. Okay. Can you think what will be due diligence for our industry? Let's say if Saefwell is acquiring another business, what kind of due diligence will do? What do you think?
Their financials we need to check. Are they compliance with the statutory authority? We will check.
Their assets we would check, like vehicles and yeah, assets we would check.
What assets?
Like means different kind of technology, vehicles, like means for patrolling, different vehicles, kind of vehicles are required. So,
Okay.
What about their share price and investors' capacity background?
What else?
their debt,
Basically, contracts. The most
liabilities.
important thing is contracts. Sometimes we'll do acquisition only because they have contracts. Contracts means there is a good amount of revenue which is almost guaranteed to receive by the company. Be specific. What we are talking about, this is very general. It won't give us good marks, asset, this and all. You talk about what's specific. Why we do due diligence? Because we think that these things are not clearly mentioned, or basically that is a strategic issue for us. If you don't take care of us, take care of that, the entire acquisition or merger can fail. things which are hidden, things which are difficult to understand. That should be the priority here. Yeah. Now your answer, please.
So their competencies, we would analyze their competency like it's written that they are providing advisory service. In advisory services, they have a lot of data. Apart from that, they have some specialization. So we would check these things also.
Okay.
Misbah, what was the question? Can you just repeat once again?
I'm saying what kind of due diligence will be specific to our industry.
Okay, okay. The margins, like, if let's say,
One thing I want to
uh,
tell clearly is when you answer, so what will determine the quality of your answer in the exam? For example, if they ask you about due diligence, and if you are giving basic answers like check their financials, check their intellectual property, or something which is very obvious, the answer is correct, but we cannot attain very good marks. Let's say if it is for 40%, you have to write only 4 paragraphs. That is enough. But best 4 examples you should give, best 4 points, then justify. So that will improve the quality of the answer. Getting the point? And obviously, if you're writing only 4, write which is very specific to the industry. Sometimes we have to do a research also. What is the problem with acquisition in security industries? If you do research, you'll understand these are the common problem. So we might also face same problem. So that should be the top one in due diligence. For example, the one common problem across industries about the debt, treatment of debt. Many times bank will say you cannot transfer the debt. So if you're acquiring certain company, you have to acquire, basically pay all the money for the shareholders plus pay for the debt. Why? Because debt is not transferable. Same thing goes with the contract. I believe here contract can be a very important. What kind of contract they have with the clients, what kind of suppliers they have. Okay, because you don't need to write all these points, you'll not have enough time and it's not required in the question. Okay, then joint method of expansion. What is joint method? When we are not trying to give the ownership, so we can do joint venture, separate business entity whose shares are owned by 2 or more business entities. So this can be a starting point. Usually mergers and acquisition is like getting married, some people will say, and joint venture or joint method of expansion is like friendship. So first we are doing friendship, and if they are happy, it can turn into a relationship full time. That's what business do, and sometimes they just want to be friend. Like joint venture, we share our resources, risk and rewards. Same thing with the strategic alliance. As a cooperative business activity formed by 2 or more separate organizations for strategic purpose, ownership, operational. So it can be for strategic synergy, positional opportunity, limited resource, anything. In our case, I believe strategic alliance can be more of data. If you're getting certain information, that will help us in better decision making, and we can share certain information with them. That can be a good strategic alliance. Or for example, in airline industries, they are doing strategic alliance to work on new engines to reduce the pollution, because everybody is facing the same problem. It's an industry level problem. However, while doing this joint method of expansion, risk management is about getting, if we do with a very big company, so there is a chance the bigger company can take over us. On paper, it might be strategic alliance, but their resources, their brand value, and everything might be very difficult for us to negotiate. And if you do with too much small player, then they won't add equally to the strategic alliance. So we just have to see, mostly if it is done between equal players, it creates good synergy. It creates benefit. Because if you do it too big or too small, there can be a problem. And another issue here is investment of the cost. There might be always a chance of higher expectation from other parties. So all these things should be taken care. Otherwise, it can lead to contractual inadequacy risk, and which can lead to a lot of other financial risk, business risk, reputation risk, so and so.
But the name will be used as a different company name, or there will be a separate brand, in separate
Company
name
name
of the company.
will be used. Company name will be used. That's the problem. If you are doing a strategic line, let's say with a small subsidiary of Google, also Google name is there, and you're doing that because of their brand. If there is an issue, Google's reputation will also come into place. Remember, when we are a big company, when we are operating for almost 100 years, we have more to lose. If anything small happen means our reputation is going for a toss. But for a smaller brands, they don't know. I mean, they are not well known, or maybe they are known only in their country. They don't have much to lose. So here, values becomes very important. Ethics becomes very important, because certain companies are not interested in ethics. They are okay only with the laws. If they're legal, they are enough. But certain companies like us, who's operating for very long, we care values, we care ethics. So if you do a strategic alliance or a joint venture with a company who don't have good values or ethics, will struggle, because they'll prioritize profit, will prioritize values, ethics. This thing also need to be considered. Sometimes what happened, we care about everything, but we have just done a partnership with a company who doesn't have good reputation, or they have been facing certain issues on ethics or even legal terms. And if we just do a partnership, so it will affect our reputation. Why? Because their bad reputation is now linked to us. There is a very good real world example. I am not exactly remembering the company name, but I can tell you. So what happened in India, Bhopal tragedy, if you remember that, a lot of people unfortunately died because of gas leakage, right? Almost 25-30 years back, or even more. You
Correct.
must be aware of that incident. Okay.
Yeah.
So what happened?
Yes, sir.
That company was acquired by a global pharmacy company, manufacturing company, pharmacy, medicine, everything. And they became the sponsors for London Olympics in 2012. They just acquired this company almost 6 months back. And that was almost after 3 decades of this incident, when they ran away from here. Okay. But as soon as they acquire, and they were one of the prime sponsor for the event. But this news became so viral that they've acquired a company which has such a bad reputation and which has caused death to the people. This means this company is focusing only on profit. Otherwise, why they would have acquired a company with such a baggage? What the committee did, Olympic committee, they just throw them out as an official sponsor. They said, we don't need your money also. Because of you, our reputation will also get affected. You can imagine what they have done it, and after 3 decades, somebody acquired them. Their reputation also got affected by that.
Mm.
So if you do something bad, it will catch up today or tomorrow. Companies need to understand that. And nobody will be buying us, doing partnership with us. Maybe in the short term, company can enjoy profit, but in the long term, they have more to lose. Okay. So one of the reason why Saefwell is existing more than 100 years, because we are very ethical. We are following our values. We are not focused on short term. What is short term? Short term is mostly just about profit. But in the long run, if the company want to be successful, they should take care of the society. They should take care of the employees. They should take care about all other stakeholders.
See, but this joint venture, these are things happen only for the short period of time. Let's say one year, for a special project, they will go for a joint venture. They will not go for, end of the, term. It will only for the limited period, right?
Limited period, but for our benefit. So
Yeah,
how it
for
will
our
look
benefit.
for the market? Market will say this company talks about ethics so much, but when it comes to their benefit, they'll go with anybody.
Mm.
You can even compare this to the political parties. People will change their perception. Though it is a short term, they are not giving away their ownership. But unfortunately, business is like this. We are talking about ethics and all, but in the real world, companies will do anything. It's ruthless, right?
But company can go with political parties also.
No,
Like,
I'm saying
indirectly.
no. I'm not saying companies going political. But two political parties can do joint venture for a short time. Then again, they will go separately for their benefit.
Okay, okay. Yes, 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 yes. This happen very common.
Maybe their values are totally different. Maybe one is right wing, one is left wing, but still they come together. That's also kind of joint venture strategic alliance. They are not merging permanently.
Correct.
Franchising is also one part of it, where we don't want to do entire business with us. We'll just give our brand. KFC and all these are very famous. Licenses, mostly working in medicinal industry, alcohol industry, the right to exploit an invention or resources in return for a shares of proceeds. Percentage you can work. Outsourcing is basic. Outsourcing means contracting out aspect of the work of the organization previously done in-house to specialist provider, like internal audit. Companies usually outsource their internal audit. Okay, what do you think? Maybe outsourcing can be an important topic for our exam. What do you think about outsourcing in Saefwell? Do you think we can outsource some of the services or not? Because I believe we might have so much of services. Doing everything in-house can be a problem. And
Yes,
sometimes
yes.
if we are not taking the responsibility, what other players are, maybe the clients are expecting from us, just because we can't do it ourselves, we can also lose the client.
Yes. We can do outsourcing for the employee credential check. Like, there is a company called First Mover Advantage, right? So I think we can outsource the credential check to them, where there is an employment for the clients, right? So this one we can do that business outsource.
And sir, we can do like intelligence-led services are giving 15% of revenue. So like procedure, right?
Yeah.
Yeah. So means they have outsourced this work to another company. So we can do in the same manner. Apart from that, like we are thinking to do the facility management in the future. Means we can think about that. We can go for the facility management. So we can from starting itself this facility management work we can give to we can outsource. I mean.
Right. Or maybe we can just outsource some part of the business, or in some countries, and some will have in-house. Basically, operating in so many countries, every country's business will be different. So what we have to do here is look at the advantage and disadvantage of outsourcing. And in that service, what they're providing, if we feel there is more advantage, we can just outsource it. But remember one thing, as a rule of thumb, mostly, you cannot outsource your core competency. If you outsource your core competency, which is your order winner, then anybody can copy it. Threshold competencies can be outsourced. For example, a company is very good in manufacturing, then they can outsource packaging, marketing, sales, almost everything. Finance can also be outsourced. But if they outsource manufacturing also, then they won't have anything left. Because in outsourcing, you have to share the secrets with the company. They might not disclose others, but they can start and they can copy it.
No, outsource a certain portion of things, like, not to all, right? Like normally, let's say manpower, let's say. Okay, so we can, we can outsource our manpower requirement to a different agency, right? That also we can do.
And there are
That,
companies
these are,
who have outsourced everything now. There's a brand called Mama Earth in India.
yeah.
So they have even outsourced their manufacturing. Everything is outsourced. They are just managing the brand. That's it. And now they are a listed company.
Oh my goodness. Okay. Alag
It was
Ghazal, right?
before,
Yeah.
right?
Correct, correct.
Sir, I know that this Mama Earth was nothing in the starting, just a small organization in the Gurugram, right? So
Correct.
after that, it become a giant.
Mm.
So they are one of the example who have managed outsourcing very well, because their manufacturing is being looked as a core competency and they have outsourced it. But ultimately, it's not their core competence. Their core competency is about branding, marketing. And even if you see their financials, the maximum money is going into marketing only. All right. Then what are the risk and return? Obviously, risk can be strategic fit, cost sharing, knowledge sharing, profit sharing. There might be conflict once the things have been started. So it's better to do everything in a written format with the contract and take experts' advice. Risk of international growth. I mean, this is similar what they have mentioned in the first chapter, what we have seen: political, foreign exchange, need of more capital investment, customer relationship, increased risk in the supply chain, ethical risk, cultural risk. International growth can be one of the strategy, especially for the manufacturing company. They are looking from exporting. The firm sells products made in its home country to buyers abroad. So if you see a Chinese company, what they do, they follow exporting strategy. Overseas manufacturing. A lot of other Western brands, they are using overseas manufacturing. The firm may either manufacture its product in a foreign country and then either import them back to its home country or sell them abroad. So if you talk about clothing industry, a lot of bigger brands, they are manufacturing it in Bangladesh. Overseas manufacturing example. Multinational, these firms coordinate their value adding activities across national boundaries. Mostly automobile, if you see, and other products which requires expertise from different part, they're more of multinational and they'll get assembled in some other part. And transnational, actually it's more of theoretical. It's like a company which is nationless. There cannot be a company as of now. It depends on the rules, but as of now, there is no company which is nationless. We have to get registered at least in some part of the world. Should have a home country. Okay. Then next thing is disruption. Disruption, I think we've already discussed. When something innovative come in and change totally the things have better. That is also an important part of risk management. We have to try to disrupt the industry. If not, be ready whatever changes are coming in. If somebody is disrupting, we should able to uh, stand with it. Otherwise, a well settled company can go into losses. Then scenario planning also. All of this is repeated. I will not go through this again. Game theory. Did we discuss game theory? I think we did in E3 about the pricing, right? It's also called prisoner's
Yes.
dilemma, one and the same
Yes.
thing.
Mhm.
Thing is all the same. Okay. Now moving on to reputational risk. So this is a very easy chapter. It's just about the examples. What they're trying to say is reputational risk is very important to mention. They have mentioned the first chapter, but still they have an entire chapter focusing on reputational risk. Why? Because just because of the reputation, a very big company which might be 100-year-old can go to zero if you don't mention or sorry, take care of reputation properly. Even in exam, I have seen this question is interlinked. For example, they will say some issue happened which might be true or a rumor, and they'll say because of that our share price is going down. So how do you manage it? How you deal with it? So basically, in risk management, whatever list you are making, make some risk and mitigation for reputational issues also. How you will manage reputational risk? Sometime it can be true, or sometime it cannot be true also. There may be instances that our competitor is pushing or paying the newspaper or media guys just to post something about our company, and at the end they will just write a line: we do not know exactly about this information, or this is just from the sources, right? There are a lot of rumors also sometimes get published in the newspaper, you must have seen, and at the end they will write, okay, we do not guarantee this is a fact. So what happens? But people don't care. They'll just read the heading and they'll start believing it, isn't it? So the
That's
best way and the starting point also we can say is managing the media, managing media as a stakeholder. How do you think we can manage? Or from your experience, if you have seen your company or any other company, how they manage media?
right. See, if some allegation comes up, against our Saefwell company, right? So, and if this is not true, then definitely we can release a press release and we can do a media briefing that, we are not related to this one, and, this allegation is completely false. And that, at least we can inform to our stakeholder in that way.
Right. So the
This way,
answer is response. Response
yeah.
to it. Okay. First point. Anything else?
So there should be good relationship with media.
How you'll manage?
Time to time. means,
By sponsoring.
Yes.
In practical life, it happens actually by sponsoring.
Yeah,
I
practical
don't know
points
if it,
only we have to talk about in this. What you will
but
sponsor?
ethical, like, they're, like in their channel, we will become a sponsor. Advertisement. We can give some, sort of advertisement to that.
That is the most important. What else? What else you will do? One is sponsoring. One is responsing. What else? At least two more points. Nikhil?
So all the things shouldn't disclose. Means, shouldn't disclose outside.
If we are giving under the table some money, that also it's illegal, right? We cannot disclose.
Don't recommend something which is unethical in the exam. What else?
So if something come on the in the media, then we should have also a strategy to cross means to reply that okay, these are the points, but these are the reasons that why this happen, and what can be done.
Okay. So in
So
stakeholder management, you might have written media, right? So what points you have written under to manage it?
I have written on the health and issue, like, if something happened to the, employees, they fight
Okay.
with the client, or theft or something. So this has come into the media also, that, they Saefwell security, they're fighting, right? They take the law in hand. So now media is, telecasting this our videos to the world. So this is also a threat, right?
You have to write media as separate. Just media as a stakeholder. Usually they'll have low interest. I mean, they have high power also normally, but in today's social media, I would say they might have high power also. So low interest, high power. How to manage? So write 4-5 points. And you might have to do some research also for this. So do research, and it should be specific to the industry. And if you go to companies' website or real world competitors, go to their news channels, not news channels, news section.
Mm-hmm.
And you
I
get
have seen
specifically
like Yeah, news channels, in the company website, they mention that, okay, the company has developed this is thing, the company has launched this is product, like this, they mention in the press release. Then company has joined with, the strategic alliance with this company. So something like that. These are the things, in the press release normally it happens.
Yes. They'll
So that
mention.
means we are giving, subscription fee to them, to write a column about our company in a good way.
Right.
What if we can say like it is under investigation by any other agency? So
Sorry.
what we can say, like whenever some issues happened in the political scenario or something, and what that people do is like they tell the media that it is under investigation by a third party.
Yes, this thing happened that media is saying something that till the time means
When some
no any
allegation
decision
happened.
come.
Yeah.
So they say that it is under investigation, right?
Sorry, can you repeat the last point?
Misbah, it's like if some issues happen, that's what you mean. Like if what something happened to the company, and it is spread around public. So what we can do is like we can do a press release or press meet, and we can say that it is under investigation by some credential agency. So you will get to know by very soon. That's what political parties do. Current scenario, right? When a ruining political party, that's what they do. So like we can say like.
Right, right. In fact, if you see some very big corporates, they also have a very high amount of stake in the media. They are indirectly a owner of media houses like Amazon. I think they are in New York Times or some company. In India also, big corporates have their own media houses. So one of the reason they are doing is to maintain their reputation. I don't know how ethical it is, but companies even do that. They are the shareholders, majority shareholders in big media companies.
Yeah, correct. You're right. But is it ethical? Means like even I am also thinking, they will talk about good things about that company only, right? Like
Yes.
recently Adani purchased NDTV, right? Correct.
Yes.
So
Yes.
now, NDTV will start talking good about Adani. So I don't know. Is it ethical? How far? I don't know this one.
Definitely, there will be a question on ethics in this. But one thing is for sure, company, especially listed company, if you want to maintain the share price, you have to maintain the reputation. And reputation, even against the rumors, we cannot say that is not a fact and we don't need to worry. Even if it is not a fact, it will affect the share price. And if it goes down for a short time, also, some people will do short selling and earn the profit. And maybe that's their strategy. That's illegal. They can just circulate some rumor. When the share price goes down, a lot of buying will happen, and ultimately when it will recover, they'll sell it. So what earning they would have made in years, they'll made in few weeks.
So this Amazon, what I know, has bought everything, media, reviews, everything. Because I have means a real example of me. I bought something and means in review, I bought a medicine from US when I was in India. So they were good reviews and means the medicine which they had delivered, that was not original. So
Not good
that
quality.
medicine was very costly. But I put all the reviews. I tried to complain them, nothing happened. They have not even put my review there, means on their page.
Oh my god. So that means the review is also not trustable.
Yeah, means they I put review 2 3 times, but it was not showing on the page because it was against them.
Right, right.
Sometimes what happen, they have a team actually in Amazon, right? So, they do, they check every time, the feedback of the customer, and if
Yeah,
something negative is there, then they will remove.
they don't publish. Yeah.
It's definitely unethical, but They will say it's legal. We cannot show all the reviews because of the limited amount space available and things like that. That's what I was telling, and we discuss in the few classes also. Ethics is good on paper, but in reality, most of the companies are not following it because it's very costly. It's very difficult to maintain that. Sorry. Yeah. So reputation risk is therefore the likelihood of losses occurring due to deterioration in the belief or opinion held by someone or something. So how it is coming to us, it can be from a lot of reasons. Some of the reasons I think we already discussed in the first chapter. Primarily, it is coming from social, environmental considerations, especially today, because the new generation is very concerned about the environment. It can also come from business ethics, like you gave Amazon example. That's an example of business ethics. They're not following it. That means if you write good review only, it will get published. Then CSR, how we are dealing with the society. Like we know, CSR is not mandatory in most of the countries. But if we are doing CSR, it's good. And what kind of CSR we are doing, what promotion we are doing. Certain, for example, I think Wipro in India, they have taken over certain schools. So they're running it completely. That will be a good CSR. So actually taking the responsibility and making a change visible. It's not just about planting trees. And most of that, I mean, we should not call it trees, saplings. That will never become big trees. They're spending so much money, but who is taking care of that? No maintenance is being done. CSR is about creating difference for the stakeholder, for the society specifically. Then ethics, as we know, ethics we need to follow. That is also a issue with reputation. If you are not ethical, then ethical threat. Usually, what can be an ethical threat for an individual? If you talk about an individual, let's say a question comes for board of directors. So it can be for self-interest, may occur due to personal financial interest, to self-review. In fact, in one of the exam, we have a question that some company want to acquire us, but there is a chance the board is not ready to sell the company, the majority shareholding. Why? Because of the self-interest. Because if somebody acquires us, who will lose the job and very difficult to replicate is the board of directors, the executive directors. There is very less probability a CFO in Saefwell is a CFO in the new company also, because they might have a CFO. And if they're acquiring us, means they're considerably bigger than us. So this person will lose a very lucrative job and position. So there is a chance just because of self-interest, our executives and maybe the all directors are against that. That is a self-interest, or we can say breach of ethics here. Self-review also may occur when previous judgment need to be reevaluated. Advocacy to help somebody. Familiarity or trust. Familiarity of trust we need to avoid. Therefore, there is rule where you have to keep changing your auditor also on regular interval. Intimidation can happen. This is very common. The manager or the directors can intimidate their team members to do certain things. Otherwise, they can lose the job. Adverse interest also. People don't want to lose the position. Adverse interest is also a reason why the employees are against the change. May occur when a member does not act with integrity because their interests are opposed to the employer. This can create an ethical dilemma. What is dilemma? Dilemma means both the side there is a problem. Let's say in one case, a director is itself is telling you to do something unethical, which you don't want to. At the same time, if you don't do, you might lose the job. Then what to do? It's a dilemma. A dilemma will only occur if there are two or more interests at stake, even if it is only an ethical duty to oneself. Because you might be ethical at personal level, but if the organization is not, very difficult. CIMA has given certain points to follow. This won't be asked, but just for the understanding. What they are saying is, firstly, gather all the fact. You don't need to learn this. Ascertain the ethical issues. Escalate internally. Go to the manager. If not, go to the board directly or NEDs. If not, you can, as a CIMA member, you can contact CIMA. Then report externally to the auditors. In the worst case, if nobody is supporting, remove yourself from the situation, but don't be in a company which is not ethical. I mean, very difficult decision to make, but that's what they believe will make companies to become more ethical. So don't be a part of a team which is unethical. Then difference between brand and reputation. Can you tell me what is the difference? Maybe you have read this also, but you can tell in your own words. What do you feel is the difference? Hello?
Sir, I'm reading.
I feel brand is much more means is a broader term in from the reputation. Actually, brand itself, like it's like a perceived value by the customer, like in their psychological mind, they will think this is a brand, like it's a perceived value which we feel as a customer. Okay, whereas the reputation is like it's like a company reputation. Company is doing good, at their services, products, and everything is fine. But brand term is more broader than this reputation.
Right.
Sir, brand we can control means, means,
Yeah, you're correct. Continue.
yeah, we can control up to some extent that okay, these are the main things about this company, and in the reputation we cannot control. Uh, and means if a brand if there is a brand for something, then there is no guarantee that the reputation would be also if they are not performing well.
Okay.
This thing I have read from here itself.
Nikhil? Nikhil, are you there?
Yes, Misbah, I was thinking.
Whatever comes to your mind, it's not about being right or wrong. You can just tell. We are discussing.
So brand is like, that value that already been established among the public, and brand value we need to, we need to always give some, standards and everything. So if in case a new product is or new services that we are giving, we must have updated every stage of that, it is coming. We must have keep some standards and everything. Either the competition must be higher or for the brand things usually. For reputation, must I need to think.
Okay. You are correct only about that. So basically, it's just about that. Let's say if I tell you about Gucci, so what comes to your mind? Luxury. Rolls Royce, luxury. Right? So what it is, it's all brand. They have created a brand and they deal only with luxury products. So we'll think of luxury. But whereas reputation is, let's say you have bought a product and you don't feel any extra value. You have paid so much extra for a brand like Gucci, and when you use it, maybe the threads are coming out, right? And you're not able to utilize it properly. The utility is not effective. That is reputation. So brand is more controllable because we can portray ourselves in any way what we want. If somebody is starting a new business, they can portray them as a luxury or as a cost leader, anything. That is brand. But what we are promising in the brand, if we are giving that to the customer or the consumer, that is reputation. What you promise, if you deliver, it becomes a reputation. Simple as that. Reputation is fulfillment of promise. However, in certain cases, even if you fulfill, there will be some amount of stakeholders or some stakeholders, they might not like it, or their expectation will be even more. So reputation is very difficult to control. Brand is more controllable. In simple word, you can say brand is controllable, reputation is non-controllable, but not 100% non-controllable reputation. If you just deliver what you promise, your reputation will be good. Okay. So in business, we have to definitely control the Saefwell brand. At the same time, we have to maintain the reputation. And we cannot just wait for something to happen, then control reputation. We should have a strategy, we should have a plan, we should have risk identified, controls identified for managing the reputational risk.
So reputation is simply that, fulfillment of the promises, right? Or the product and services.
Yes, that may be one way of looking at it. Everybody will define in certain way, but that's what reputation is. If you say something to someone and you fulfill, what will happen? Your goodwill for that person will increase. Same thing with the company. Some people might be biased, but the normal population, they are still honest. Whatever you're promising on the product description, and if you're giving that, that's enough. If you're misselling certain medicine, let's say, then definitely it will affect the reputation. We said something and it comes up with something. We said 100 grams and in a product, let's say, and it's getting only 90 grams. So what will happen? Or even 99, that 1% will affect the reputation.
Correct. And whereas brand is not fulfillment.
Brand is basically the promise, what you're doing, how you're portraying yourself, how you want the stakeholders to look at it. Then strategic alignment means what? Starts at the very top and or top of an organization. It is about the board making sure the strategic goals, the company culture, and business process align for the reason of organization exists. Basically, strategic alignment is important when two companies come together. So it is like the board of both the companies come together and agree on certain things. Next point is transfer pricing. Basically, transfer pricing is a part of finance, but why we are studying this in reputational risk? Because this is also being looked as a reputational problem for a company. If you know, Amazon in 2018 paid $0 as a federal tax in the US. They would have paid millions, but they paid only $0. How? They use transfer price. It is 100% legal. They have found legal loopholes. But the problem is the society expect you are making so much profit from here. Why you're not paying back to the government here? Why you're paying in Switzerland and other tax havens where you are saving the tax? Because the tax money indirectly come back to the population, the society, isn't it? So they were into the scrutiny. So in 2019 and later on, they started paying a decent amount of tax. They're still doing transfer pricing, but reduce it. Why? Because of the reputational risk. So what they do in transfer pricing, maybe you have already heard of it. They show more profit in area where the tax is low, and they show low profits in areas or geography where the tax is high. So and it can be done within the company, obviously. Interdivisional transfer must therefore be priced. The price of the transfer is the transfer price. How they are doing it determines how you are not expected to explain, but just as a reputational risk we are discussing it. So what it tells us is, even if you are finding legal loophole which people, the society feel is unethical, then it can affect our reputation. You are not doing anything illegal.
But this is not fair now, Misbah. If there is a legal loophole also there, if there is no chance to pay the taxes, right? We are right? We are doing correct, right? In that way, why we need to pay tax in that scenario? We can,
Yes.
maximize our shareholder value, no? In that case.
Yes, that's what come back. But the problem is in the long run. Let's say you are making a profit about in Barland, you are making a lot of profits from here. So how this money is going back to the society? Tax. Why government takes tax? To give back to the society, isn't it? But imagine you are making profit and you're not paying any tax. Everything is going into, let's say, Bahamas. I don't know, Bahamas, Bermuda, for example. Bermuda is a tax haven. There are countries who are taking zero tax. We will show all the profit in that tax havens. So ultimately, the government is losing. How government will earn money? What is the major source of earning for government in most of the countries? Forget about Middle East. Taxes. And if every company started doing this, how government will provide the infrastructure which is used by all the society, isn't
So
it?
this is even not legal because they are showing that everything all profits are coming from a country where there is a zero tax. But this is not the reality. They are showing their wrong financials. So this is also not, this is also illegal that they are presenting wrong financials.
Yes, sometimes they can represent wrong financial, as in they'll make shell companies and they'll try to, deviate the funds which is coming from different places. Yes. So there can be a legal concern also. And government don't want to lose taxes. In fact, if you know what happened in the G7 meeting, I think around 2 3 years back, 2 years only in UK, there was a G7 meet when Trump, I think, was the president. What they said is they want to reduce the corporate tax from 25 to 30% to 15%. Why? Because in the calculation they understood if they put 15% tax, the government will get more money than charging 25%. Why? Because companies are finding a lot of loopholes to pay tax in other countries where it is very low, or tax havens. So there will be a fight. That's what happened with Vodafone also. Vodafone and Government of India was in international tribunal for the case. Ultimately, Vodafone won, but it was because of the tax only. They wanted to pay in Singapore. Singapore is just a single digit tax. In fact, a lot of Indian companies, what we see, are registered in Singapore to save tax.
Yes, yes. Most of the companies actually, like, and I have seen a lot of companies, they do the shell companies, they create the shell companies, like 300, 400 companies, they will create across the globe where tax is low. And no, they will do the, transaction, purchase and sales in that way.
Yes. So that can create a reputational risk. Local population won't like it. So government want to put a price. So there is a tug of war going between the rules and regulation. The government want to come up strict, but again the corporates will do a lobbying. So it keeps on going on. If they become very strict, so companies will go into different countries. So they need to maintain that because they will create jobs also. Selling division, buying division. What happens if it is a very big global company? Internally only they'll buy and sell the products. That also can affect us. But ultimately, objective of this is to have a goal congruence. All companies should work together. Measurement, maintain divisional autonomy, minimize global tax liability, record the movement of goods, fair allocation of profits. International transfers. Transfers within an international group will often be cross borders between division in different countries. Rules reduce the profitability of high tax countries, increase the profitability in low tax, as always. But now what is government action? As we discussed, government don't want to lose the money. Government are aware of the effect of transfer pricing on profits. In many countries, multinationals are required to justify the transfer price they charge. They cannot just put any price on that. Multinationals would be required to apply arm's length price. What is arm's length price? Which is available with alternative. Even this thing is used while raising loan, and if a parent company is giving interest to subsidiary. Arm's length means in the market rate what you will get. You just have to do it according to the market rate. If you're going to an independent person, how much they will charge. In other words, they might be required under tax law to use market-based transfer price to remove opportunities for tax avoidance. And how it is done? Usually through tax haven. What is tax haven? Like Bermuda is there, Panama is there, Switzerland is there. A low rate of tax on profit, low withholding tax on dividend paid to foreign holding companies, tax treaties with other countries, no exchange control, stable economy, good communication. So a lot of things which is in favor only for the companies. Or maybe you can say the companies itself has designed the rules and regulation there. And most of these countries are very small, they don't have big amount of population. This is the only money they are getting in. Anyways, they won't ask all of this in detail. Next is fraud. Fraud is also a source of reputation risk. We have discussed in chapter 1. So why fraud happens? There may be three reasons. First is motive, incentive or pressure to commit fraud. Incentive is somebody see a very good return, or pressure, maybe the company is not treating good. That may be the motive. Second is dishonesty, ability to rationalize the fraudulent activity. Maybe they feel like, I've worked so many years, but I have not made a director at Saefwell, and somebody coming from outside, and 2 years that person became director, which is wrong policy. That may be the reason. Third is opportunity. The internal controls are not strict. There is no segregation of duty or proper segregation of duty or overpower to an individual. Therefore, what companies do, they will have maker and checker. If somebody is ordering, that person will not receive the goods. If these three things are there, then fraud can occur. So we have to try to put controls for all these three things. Bribery, like you were saying yesterday, Shiv, bribery is also a problem in our industry. This might be also a question for us.
Yes. Anti-corruption.
And bribery is not only just about money directly. Sometimes just ticket to an event. Let's say a football match is happening, the ticket price is very high, and somebody just offer the ticket. In obviously, if somebody is offering, they are expecting certain return. So what the person need to do? They need to disclose this to the management. And even from the government perspective, if the gifts are priced above a certain amount, it should be taxed. For example, under Indian law, if somebody is gifting you more than 5,000, it should be taxed. Basically, it should be come under government radar.
Correct. No, every company has their own policy. Like in
Yes.
my company also, there, Indian money 10,000 rupees maximum. We can take this one as a gift, like chocolates, bouquet, and all those stuffs. The things. If anything more than then you need to disclose.
Yes. How we can manage reputational risk? They have given some point. Maybe this can be a part of your answer also. Governance. What is governance? They are talking about corporate governance. Employee relation. Maintaining good relation means employees will not get lot of this motive and dishonesty.
Give fair salary.
Give fair salary, give them on time, give them respect, understand them, don't manipulate them. Environmental awareness should be there, what is happening. External relations. Environmental awareness is very important. I know one of my student, he is a senior position in Accenture. So during COVID time, the company was not actually able to pay the full salary. They were paying in some percentage. But actually in COVID also, they made good money eventually because of lot of restructuring business and other things they got. So as soon as the numbers improved, immediately company paid full salary and a very good bonus, which was not expected. At the time where people were firing, they paid a bonus. So that environmental awareness will give lot of loyalty for the employee towards company. There was a lot of quotes also going on COVID when everybody was, removing the employees. This is the time we'll understand how company value their employees. And Tata was again one of that. You must have heard about their policies. If somebody has lost their life, they have decided to pay the entire remaining life salary to their family. Plus, anybody in the next generation can join the job. Then external relations with the stakeholders, because many times employees will do with some other, all these people who hate the company might come together and try to do something. So relations are important. Risk profiling. Risk profiling is like, I think I gave you an idea before also, highlighting which people are at the top of risk profiling. Maybe red flags. Somebody has already done this in the past, or somebody is going through so much financial problem, or somebody is going through, let's say, some disease, it requires a lot of expense, and then earnings and expense are not matching it. So there is a high chance that person will be the first to do it. Policy framework, what policy we are setting. Risk sensing tool. Have you heard of this risk sensing tool?
No.
Any idea what it is? This is very interesting actually. Risk sensing tool means they will not wait until something is happened. For example, like one of my student was working in a pharmaceutical company, and we have discussed the real example with that. So they have a team for risk sensing. What they will do is, it was an Indian company, so they'll do research about all the things that have published in the newspaper about that industry, everything, all small and big newspapers. Then they will go to social media and see what all have been talked about this industry or about this company. So basically, they have a complete idea, if not complete, almost complete idea what is happening, what people are talking about this industry, what people are talking about this company. Because what happened overnight, nobody will go against certain company or in favor of that. Slowly, that thing will build up. Slowly, the fire will catch up, right? So before itself, they'll understand what is the mood of the people, what stakeholders are thinking about the company or brand. So if you know everything real time, you can take better decisions. And obviously, if you are proactive, it will help us. Because what happens, companies otherwise, until something happened, they won't take any decisions for that or they won't respond to it. But via risk sensing tool, you'll be proactive. You'll just be live with everything, what is happening, and we'll stop it at the initial stage. Okay. I mean, we are into risk management business, so risk sensing tool should be even important for us. Then next is response to crisis. Response to crisis means there is a problem with the business, there is a problem with the economy, any types of crisis. So we should again have a proper response team available. What will be our response to that? How we'll plan? If it is due to financials, what we'll do? If it is about the other stakeholders management, how we'll do? So business is all about being as much proactive as possible. Everything should be, or almost everything should be ready. For example, they are talking about a news reporter. So we'll have a dedicated person or resource to talk to media. In scenario planning also we have already seen. Okay, any questions?
No, sir. Sir, I'm coming in 10-15 minutes.
10-15 minutes. One
Yeah,
second.
you
So
continue. I would see the recording.
okay. Yeah. So next is corporate governance. We'll do the corporate governance and close our first session. Basically, corporate governance is related to our pre-scene also. So we can look in simultaneously with that. I hope Shiv and Nikhil, you are still fresh.
Yes, yes.
Yeah, that's all right.
And things are very, logical. It's not about some calculation, so you'll get very tired. Okay. Now, what is corporate governance? They have given one definition, but you tell me from your understanding, what is corporate governance and why do you think we are studying this under risk management?
Corporate governance means, like the policies and the procedure, the system by through which the rules and regulations, how the company should be directed and should be operationally, work to achieve the shoulder, objectives. This is like, the system, the tool.
Okay. Nikhil?
Corporate governance, for me, I think is a set of rules and regulations that must have followed by the employees and all the uh, board of members. Uh, and it will, it is describing what all things are ethical and what all things are to be done. And it's a kind of a system that need to be followed by all the members of the company.
Right. So basically governance, even this thing is used for the word government also, the ruling party that govern the nation. Governance is basically controlling it, setting the rules, setting the policies, and setting a SOPs for most of the things, we can say. Standard operating process, how this thing should be done, how that thing should be done, who will be the responsible, who are the stakeholders, how they'll get benefit. And why we are doing it? Because if you don't do, the company can collapse. It's a part of risk management. Therefore, we are studying this in P3. Why it is a part of risk management? Imagine there is nobody controlling the organization. Imagine there is nobody directing the organization. There is no leadership. So what will happen? Everybody will do what they want. There won't be any goal congruence. Right? So there will be very much risky for the business to operate. In fact, there is a high chance it will collapse. Okay. However, just as other risk, this risk is also keep on evolving with the time. So when it evolves, our corporate governance policy also will evolve with the time. So in this chapter, we'll see from the UK perspective, what kind of corporate governance need to be done. Firstly, if you talk about the importance, corporate governance is good for everybody, but if you are a listed company, it becomes a mandatory. For a company like Saefwell, it is mandatory to follow corporate governance. So listed companies are required to operate systems of corporate governance laid down either by statute or professional organ. Statute means government. The requirements are often given to support to stock exchange. In our pre-scene, they have mentioned well-regulated. So what does it mean by well-regulated? We are following the corporate governance. The development of corporate governance code is closely associated with the UK code. And that is for our exam also. And UK corporate governance code follows principle-based approach. So there is a difference between principle-based and rule-based approach. Rule-based approach is followed in US, for example. Rule-based approach is like black and white. If you don't do this, you'll face the consequences. There is no gray area. It's very strict and very long. Whereas principle-based, which most of the countries follow, including UK, is comply or explain. There is a small gray area also in between. If you are not complying it, there's an opportunity to explain. And if you explain with a legitimate reason, it will be accepted. Let's take an example. All listed company should have internal audit. Okay. Let's say one company is in UK, one company is in US. A US company, if it is listed, it's mandatory to have, even if they feel like they are managing their risk properly, their controls are, everything are okay. And if they don't follow internal audit, they'll face the consequences because it's rule based. But same thing happen in UK. A company feel like the risk are managed and controlled. It is a rule here also to have internal audit because they are listed, but they don't have it. Still they can be safe. Still they are not in breach of law. Why? Because it's principle based approach. So in principle based approach, there is an opportunity to comply or explain. So they can explain with a legitimate reason every year, saying that we don't have internal audit because of this reason, and we are able to control our risk. Whatever things we are expecting from internal audit, we are able to do within our team. They can audit. And that is one of the reason even in our board of directors is not balanced. We need 50% NEDs. How much NEDs we have?
Only three out of
Only
five, only
three.
three.
So because of principle based approach, we are still okay. We don't say it's illegal. It's not the best case, but it's not illegal.
So US has having rule based approach, right?
Yes.
So that means okay, there is a rule and we need to
Comply
follow like
or
that.
face the consequences. Either you comply or you face the consequences. Here, if you don't comply, you can explain.
Okay. So this approach is good actually. Like across, I think most of the country follow this one. Then it's good, right?
Yes, principle based is actually better. But there is a chance sometime companies might try to use it for their benefit. I mean, everything has advantage and disadvantage. But in rule based, want to mitigate this risk, they have made it very, very detailed for almost every scenario. they have made certain rules. But here they don't need to go in detail. Why? Because they have given an opportunity of explanation. It's not part of our syllabus. They won't ask all of this, just for the understanding. Then it should be appreciated corporate governance has links to risk and internal control. Ultimately, why we are doing corporate governance? Because to manage the risk, isn't it? Right? And what will happen? The risk will change, so the corporate governance should also change. Because previously it was not expected that a director itself or CEO itself can take decisions against the company. But there has been so many instances the CEO itself did something for personal interest rather than company. So what we did, we added chairperson. We made it that the board should be majority of non-executive directors. So what is happening with the time, the scenarios, the experience, the frauds, what are happening in the market, the corporate governance rules and regulation is also updating. That's what they are saying. Development means the same. Government regulations have developed largely as a result of series of corporate failures in 80s and 90s. Corporate governance themes that began to emerge from this collapse were poor financial reporting, raising questions about audit. Because when companies collapse, there was a reason internally. It was not always that because of market or disruption they collapse. Sometimes their internal control was not good, their reporting was not good, that audit was not effective. You're getting the point? Or the board of directors were not thinking about the future effectively. And after the 2008 global financial crisis also, there was more changes made. Now we are into 2024. So can we say we are following what changes happening 2008? No, they have made again changes. So it's a cycle. It will keep on improving. Like in the last time we were discussing, there has been debate going on in the market that non-executive directors should also get payment or higher payment or shares option in the company. But the problem is, if you do that, their independence will reduce. Why it will reduce? Because their financial interest will also come in now. So they might ignore the shareholders and think about their personal interest. What do you think, Shiv and Nikhil, about this debate?
Yeah, I think this is fine actually. Non-executive should not get that money, financial interest. Then the whole motive will be, the independency will go in a toss. Or
Right.
maybe some slight of, some small remuneration or in the remuneration in such a way that it should not affect that much. And again, selection of entities is, it's really a big matter, right? Like let's say if they are coming from the good financial background or something like that, then it's okay. But if it is from the, poor and then, then the thing will change accordingly.
Okay. Nikhil?
Sir, I'm here now.
Okay.
So the Misbah's question regarding remuneration for the internal audit, right?
Non-executive director.
Non-executive directors. I think everybody get paid for their service, right? No one is working,
No, non-executive
without.
directors are not get paid for the work they are putting. They are just getting a small amount just for their time and dedication, which is very, very less. Maybe just a fraction of what executive directors are getting. So the question is, they should also get paid high. They should also get paid for their commitment they are giving. But the problem is, if we do, there's a dilemma. If you pay them, then their independence will come down.
Sir, what I think that if you don't pay them, then their independence would come down, because they would means if they are getting money from other sources, like for example they are doing some kind of thing with executive director, then in that case they would get some money from them, right? And in case I mean to say that they should be paid, so that they should have an objective motive that okay, they are doing this thing for this purpose, because everyone want to be paid if they are doing something.
Yeah, that's what I
From
feel like.
indirect sources, like from like they can go with the executive directors and can do some kind of partnership with them, so it can be.
They are being paid actually, but a very lesser amount.
If you guys have
I
read
think
this
reasonable amount should be paid here.
No, not paid. I hope you have read this chapter because yesterday I told you they are being paid less according to the article of association, according to the fixed amount, which is very less. Why it is less? Because these people are already successful and they are working as a CEO, or they have their own business, or some people are retired. So their first motive here is not money. Because if their first motive becomes money, and obviously when you are paying them, you'll pay them according to performance, and performance will be linked on certain things. So they can also become biased, and they'll think of their personal first, then the shareholders. And the primary reason why NEDs are there for the shareholders, they are the watchdog for the shareholders. But executive directors are not watchdog only for shareholders, they are doing work for all other stakeholders also. Okay. So what is the principle talking about is there should be a division of responsibilities. Same person should not be the CEO and chair. So if you look in the Saefwell, we have chairperson also different, CEO also different. Pratima is chair and Greg is the CEO. Are we following this concept? Yes. Then apart from that, they are saying three main things. There should be three committees. What are the three committees? Remuneration committee, audit committee, and nomination committee. Do we have that?
Yes, we have.
Yes, we have all three committees. This committee is good to have. We have that also. Then they have given division of responsibilities. This is quite basic. You can just read through it. What they are saying: provide leadership, taking a role, and all of this. They won't ask you all of this in detail, but good for understand. What are NEDs? So basically, NEDs role is to scrutinize the performance. NEDs should scrutinize the performance of management in meeting agreed goals and objective and monitoring the reporting of performance. So their role is to scrutinize plus contribute to. And primarily, they are there to satisfy the integrity of financial information. A lot of fraud that have happened, or they were misguiding the stakeholder, was through creative accounting, or they are not honest, or not integrity was there in the financial statements. Therefore, what we have done, we have given all the committees in the hand of NEDs because they are more independent. They are responsible for determining appropriate levels of remuneration of directors. How they do it? Through remuneration committee. Have primary role in appointing and where necessary removing executive directors. How they will do? Through nomination committee and in succession plan. But NEDs cannot just come and scrutinize. They themselves should bring lot of knowledge to it. So to be effective, firstly, the NED themselves should contribute for trust and openness in the business, be well informed, have a strong command of issues. We cannot get an NED who doesn't understand anything about the business. They should also continually develop, refresh their knowledge and skills. Because if they don't understand what's happening in the market, they cannot contribute. Ensure that information is provided sufficiently, be ethical. If they don't comply with all of this, they can also lose this. Question intelligently, debate constructively, decide dispassionately. Why dispassionately? They cannot just try to move the decision on something which they are passionate about. No, our personal interest should not be first. Company's interest should be first.
They should be well aware of the business also, right, Misbah?
Definitely.
Means they know everything, right? Depth of the business.
Yes.
And
They should be well aware and continually update to the changes happening in the industry. So at the year end, even NED's performance is evaluated. If they are not bringing in any expertise, then no point having them.
who will do the
The nomination
check for
committee.
the nomination committee? Nomination committee, all entities are part of that nomination committee then.
Yes, so other NEDs will do for others NEDs like that.
Okay, okay.
Each other. In nomination committee, we can have an ED also. Minority. Maybe out of 3, 1 can be executive director. And why NED need to be independent? To provide detached view, expertise, to provide shareholder with an independent voice in the board. This is a very important point. Provide confidence, reduce
Which
acquisition
one is
of.
the important
Sorry?
point? Which one you told?
To
To
provide
provide shareholder.
independent voice on the board. So NED is basically talking only from the perspective of shareholders, the owner's perspective. For example, the CEO is saying we should improve the salary, we should give bonuses. But NED will say, no, we should not because it will affect the shares or it will affect the dividends for this year. For every year, we have to compromise on the dividend if you increase the salary. So their mere concern is the owner of the business. That's it. But executives, they have to run the business. They have to take care of other stakeholders also. The NEDs will also have meeting with the shareholders without the presence of executive directors. And I hope you understood the reason behind it. Because in the past, a lot of companies collapsed where executive directors were taking decisions for their personal interest. Because you have set the remuneration based on the profit. So what they did, they artificially increase the profit. They don't invest in capital expenses. You getting the point? Hello? Am I audible?
Yes, sir. Yeah, yes.
Yes, Mr.
You're understanding the logic. You just understand the logic. These points, you don't need to remember all of them. If you just read it, it will make sense. To provide confidence in corporate governance, to reduce acquisition. These are asked in individual paper, not in case study. Then threat to independence. What can be a threat to independence? Again, it is a not asked, but for understanding. They should not have material business with company in last 3 years. Should not be employed in last 5 years. Should not have cross directorship in other company. Cross directorship in other company means they can have, but not with our supplier, not with any other stakeholders. Because if they are executive directors, we discussed this point with our supplier. So what will happen? They'll push that we should not change the supplier. Their personal interest will come in. Their independence will get affected. Receive other remuneration from the company beside director fee. So they'll get some amount of director fee, but they should not get other remuneration. Should not have close family ties with the director. A father is, let's say, non-executive and son is executive, or husband, wife, something like that. Should not be a significant shareholder. They can be a shareholder, but a very small. Significant shareholder means they'll become key players. And last one is serve on board for more than 9 years. Actually, all these points we cannot see because they have not given in the pre-scene. Only one thing we can see is 9 years, right? And what we notice, this guy joined in 22, Muraksha, then Nils joined 23, Professor Martina 2021, and ultimately the chair in 2022. So we don't have anybody who is 9 years or even more than 7 years. That means no need
Nobody.
to. Yes, this risk is not there. About other reasons, we don't know. But we can just assume they might have obviously followed all these principles before making them a member of board. And nobody was employee of us. This also we can know because of their background a little bit. Strategic role, contribute or develop a strategy. Scrutinizing role, review the performance. People role, decide remuneration. Risk role, financial system, accurate risk management, all of those. So ultimately about the committees only. The most important thing here is the 3 committees. So if you start with the audit committee, nomination committee first, what we need to do, majority of NEDs on committee, we have discussed. The chair can be on committee, but can't chair the committee in the nomination committee. If you see here, you go to nomination committee, chair is there. So chair can be there, but chair cannot decide her successor, which we don't know. I believe she's not the chair of the committee. Chair means the leader of the committee. Every committee will also have a leader. There should be a formal, rigorous, and transparent procedure. This thing we don't know, but we can assume they have done it. What is the responsibility of nomination committee? The name itself suggests. Review regularly the size and structure, composition of board, balance of board. This is lacking in us. We should have at least 2 more NEDs. Diversity. Do we have diversity in the board? Yes. Balance of skills. Balance of skill, knowledge, and experience will keep on evolving with the changing projects what we are undertaking. Operate independently for benefit of shareholders. Okay. Do you agree with the responsibility and duties? I feel only the balance on the board can be improved. Rest all is fine. What do you guys think? Okay, there is one more problem. One more problem. What is it?
I feel one person, there is this operational skill guy actually. This is missing. Those who understand operation in board. I could not find that, any operational guy. Everyone is, accountant, the economics, the HR. I could not see any operation related. The core business.
And one more very important thing is if chair is removed from the audit committee, we should have somebody in finance.
Yes, that is required. Yeah. Because chair cannot be part of the audit committee. So if we want to remove her, then we need to place someone else, right?
Yes.
Next committee is audit committee. What they need to do, the primary role is integrity of financial statements, guidance on annual report, review companies' financial internal controls, monitor review effectiveness of company audit function, recommendation, appointment, reappointment of external auditors independence, very basic. And how they are made up of is the board should not be a part of it, and everybody should be non-executive directors in the board. Next, if you go to remuneration, again very logical, setting remuneration for everybody, including the chair, the directors, and even the same culture will go to the operational team. Your remuneration is also set by remuneration committee, senior managers. And ultimately, this remuneration and nomination committee will work together. Why? Because we want to promote talented people, senior people to stay with the company for long term. So what we'll do, we'll give them share options, but for long term. You cannot just take it now. You'll take it after 5 years, 10 years, like that. And if you're paying for NEDs, it should reflect their time, commitment, responsibilities. Then when you're setting a remuneration, it should be clear, simple, realistic. Ultimately, there should be transparency. It should be motivating. Why companies give bonuses? Obviously to motivate, right? And if you're motivating them, it should be very clear. What if they do? They'll get the bonuses, and it should be doable. Sometimes companies will set bonuses which is not attainable just for the show off. So employee will get demotivated. Mostly in the exam, we have seen questions coming from audit committee, effectiveness of audit committee, role of audit committee, like that. Then directors remuneration components. So here we are talking about executive primarily. What they are trying to say is whatever remuneration we set will affect their behavior. For example, it can be basic salary, performance related pay, pension. Behavioral impact means if you are paying too high, let's say a director is getting 10 times or 50 times more than the employees. This can happen. So what will it will? It will motivate the director and boost her ego, his or her ego, but other team members will get demotivated. And if you're giving something based on performance, it should not be too small, easily available, or not too big, which is almost not available, achievable. So setting the remuneration itself is difficult. And we can give executive share options to motivate the employees to stay with the companies for a longer term. Okay, you guys can give one point each. What do you think is a good remuneration for directors or our employees in general? You guys have been working. What do you think motivates you to stay in any company? What kind of remuneration you will like?
Salary, bonus, plus other incentive, other allowances, and facilities.
What facilities?
Medical.
Give some sort of car, house, and all those stuffs, right? And register for the training also. They give subscription fees for the training and all those stuffs, right? Maybe part of some clubs or something like like organization, some sort of social organization also. Member of that club, that also gives boost.
So
And also
basically,
that.
sorry, interrupt, Shiv. When you're saying a point, have a motive in the mind. Okay, I'm giving them health benefit because they should be happy. They should not have a problem with the heavy expenses of medical insurance or other things, and they can focus on the work. I'm giving them share options because they can stay with the company for long term. You link why you are giving certain things. Okay, yeah, continue.
Yeah, done. My side done.
Okay.
So the same points, and should give pension like we are giving to employees, as well as means share part in the share options, as well as means for their family. So we can provide to the family also.
What you can provide to the family and how it can help the company. Every point link how it will help our company.
Like medical facilities, medical insurance we provide for their family also. For example, means for their parents, we can provide the medical. So it would help them because it would motivate them to work for a long period of time. And some special benefits which other we can do like this also providing, so that they should
What
be
what
stay here.
extra you are giving? Why anybody should choose your company?
Yeah, means
So
I'm
these are
saying
basic points. You are saying health.
ESOP, we can give actually share of our company.
Others are not doing that. Why? How you can become employer of choice? In E3 also it was there. In the last chapter you are discussing the leader of digital organization. You are the leader. How you are becoming
high percentage of increment in salary, like other industry average, that they are giving.
Then
Like
you are
Saefwell
Remuneration
They are
on based
providing
on salary,
one,
profit.
one by one. Let Pooja finish, then Nikhil. Yeah, Pooja.
I did completely.
It will affect our profit also. It's easy to say, okay, double the salary, but can you do it? How it will affect our profitability? You have to think about other stakeholders also.
So we would have to manage both things by both, means not
How
too
do you
high
manage?
and not too less.
How?
increase revenue or by reducing the cost.
If you are suggesting something in exam, we might think, okay, double the salary, increase the salary, do this. We should understand about other stakeholders. It's always better to justify why and how you will do it. Yeah, Nikhil, please continue.
So I was saying such a percentage of profit when they are every company have the set of profit for each month they have to attain. So on the basis of that, if you acquire, 10% more than the last month, so he must have something extra payment. So there must be a motive for him, and it is good for the company, and he is earning his own. That's one of the cases, and some, facilities like, as we all discussed, some insurance education of children and house allowance and travel allowance and club facilities and all. And some people used to give some purchase cards, discounts and everything. Then we can part of a share, you know that's all.
Okay.
If our director is performing well,
Okay.
board of directors are beneficial for our company, right? So ultimately, our company would grow. The shareholders would benefit, and employees would benefit. So it would be win-and-win situation for everyone. Some kind of incentive we should provide them.
Yeah. Incentive based on the performance. So these things make sense what you're saying, but it's better if you get something creative which nobody is doing in the market. So do some research also, what the top companies are doing, how they are retaining. You can take the example of Tata's also, how they are helping employees beyond their work, their families, their education, and in the especially the times of crisis, because ultimately people take emotional decisions. In time of crisis also, they are always supporting the employees.
Correct. Tata is like the best employer actually.
So things like this you can add, and you can even give the example of the companies who are doing this. Okay. Same we'll go with the ESOPs. Then what they should be provided, they'll have financial incentive to maximize the share price and investment opportunity that will be attractive to shareholder because runs at high might. So basically, if the share price increase, it will affect shareholder also and directors also. Then responsibility of the audit committee. What we have discussed there, almost same thing. Review financial statements, review company system. You can just read it once, discuss the auditors about significant matters. Logical point. If there is some confusion, we can discuss in detail also. And for internal controls and audit committee difference, we'll discuss about internal control in the next chapter. Indeed. Then SOX is basically a US-based rule-based approach. It's not part of us, but they have just given us to understand the difference. What we are seeing now is principle-based approach. So rule-based is very strict, as we know.
Sir, what I was saying, you were saying it is important to time the question. So I think you should just that audit explain.
Yeah, so Pooja, what we discuss is the almost same points what we have discussed in the previous one. Review auditors report, review internal control system. The points are same. That's what I'm saying. And internal control to audit committee, we'll compare in the next chapter. You read it once. I hope you have already done. If there is confusion, we can discuss on the points. Points are same. Review of the financial statements, companies' internal financial controls, auditors, all of those. Hello?
Okay, sir.
Am I audible?
Yes, sir. I said okay, it's fine.
Okay. Next is SOX. SOX is not part of exams, but just for the understanding they are putting in how it is a difference. Basically, rules and regulation is not part of the CIMA syllabus, but for the understanding, if you see, for example, in SOX, they say audit committee, company must have an audit committee, will be disallowed from trading if it does not have one. So in rule base, there is no middle option. It's just comply or face the consequence. Like here, if you don't have an audit committee, they're out. Even they might say in detail that chair should not be a part of it in SOX. But in our case, also chair should not be a part. We can still do it. Why? Because it's principle-based approach. And principle-based approach, you can comply or explain. You can explain the reason why you are putting chair. One of the reason we can see is we don't have anybody else who has financial expertise or who is coming from financial background. Therefore, we are putting chair. And we cannot allow executives in the audit committee. So only option for us is to get a new non-executive director with finance background and become the audit member of our company. Then auditors' independence. Auditors are restricted in additional service they can provide. Additional service means if they're providing other services for us, let's say financials or any kind of thing. So they might try to help us or benefit us here, and that can compromise the quality of the audit. Audit partner should not serve more than 5 years. Why? Because of the familiarity threat. Directly, indirectly, everything is linked to the risk. Restrictions on dealing. Directors prohibited from dealing in sensitive times. What are the sensitive times? Let's say if you're buying a company, there is a chance the share price can go up. So there will be a lockup period. You must have already been heard of it. What is lockup period? That will not allow the internal employees to buy or sell share during that sensitive time. I think is UK is around 84 to 90 days. There will be some 2 to 3 months normal.
Only employee cannot sell the share, right?
Yes, you cannot sell or buy the share.
Yeah, correct. But the outside people, the internal party, they can buy and sell.
But outside people are not aware about these issues.
Yes, yes.
Like for now, we are outside to a lot of companies. We don't know what's happening. We'll only come to know when the decisions have been made and things become public. So by that time, share price will already jump up. Yeah, if there is insider trading, which is illegal, that time people will know. And insider trading is illegal. Increase financial disclosures. Financial reports should be detailed of balancing of. Certification of accuracy must be vouched by CEO and CFO. Financial statements, if there is any problem, it will be an CEO and CFO's responsibility. In fact, in US, the rules are so strict, the director, the CEO and CFO can even go to prison if they just sign in something wrong or there is a creative accounting. It's very strict. There is less chance to explain. But we don't need to go in detail. Why we have given only this part? If you see in the syllabus, they have not gone in detail. They're trying to do two things here. First, to make us explain. Both are directly, indirectly trying to manage the risk. Secondly, they're trying to explain the difference between both. And as we already discussed, principle based looks better because there's an opportunity for explanation. Then how governance will help the strategy? Basically the advantage. What are the advantage of following corporate governance? It can increase power of governance bodies. Increase shareholder power. How it will increase shareholder power? Because you have entities, and entities are directly responsible for shareholders, not for other stakeholders. Pressure on board to formulate strategy, better strategy, more scrutiny, more emphasis on risk assessment because you have audit committee, risk committee. Greater scrutiny on the decisions they are making, especially in mergers and acquisition. Why? Because sometimes CEO can take decision for their benefit, but now we have a CEO and chair. These two are the most powerful positions, and both should be separate. So what is happening? Nobody can take decisions for their personal benefit. And corporate governance also improve diversity of the board. And diversity is not only about people from different background. Diversity, sometimes in some books you can read diversity is also talking about people from different background. Like let's say differently able people should also be allowed. Different from people from different communities which are not represented at all, minority, global level minority, right? That kind of people can also be part of the board. Adequate internal audit and control system should ensure that the board has accurate information, because one of the role of the board of directors when they're making decision to get accurate information. So company will have a policy to get information timely and accurately. And ultimately, it's good corporate governance is attractive to investors. These are the points they have given. Can you guys also add one point? Why do you think corporate governance is important? Or maybe you can even say a disadvantage if you feel any. What do you think? Hello? Apart from this, can you think of any advantage of corporate governance for Saefwell? Or you can even say a disadvantage if you think of.
So it would be expensive. I mean,
Very good. It's expensive because to have so much committees, so much policies, always have the information, nothing comes for free. There will be a cost, not only financial, but other resources, time and everything is involved. Very good. Then
Disadvantage is that it will create bureaucracy.
right, it can even lead to politics in the office. Any advantage? So what do you recommend is good? Let's say a company is not listed, and for unlisted company is not mandatory to follow corporate governance. So what do you recommend that company, not for Saefwell, to have corporate governance or not?
yes, the corporate governance is required because otherwise people would do according to their wish. Means, like board of directors are going to for their benefits, so it's a kind of must thing. Means it must be there.
So you think even small and medium companies should do that?
Right, right.
That's true. And actually, if you see in the real world also, a lot of small and medium companies started to have corporate governance. I mean, they won't follow everything because of the cost involved, but whatever they can, they'll try to do it. So that's it from corporate governance. In the next section, we can discuss about internal controls and continue.
The
And
time